This is the Commodities Institute podcast, and I'm Emily Costa. It is Thursday, December 11th, 2025, and today we're digging into a whirlwind of stories reshaping the global commodities landscape. From an oil tanker seizure that's rattled geopolitics, to Asia pulling ahead in the clean power race, to rare earth tensions that have automakers on edge, it has been a remarkable 24 hours. So settle in. Let's slow down and walk through what truly matters beneath the headlines. I want to actually begin today not in the oil markets, though that is where the loudest news broke, but in the carbon and power world, where something quietly historic is taking shape. New data shows that major Asian economies, China, India, Japan, Vietnam, have managed to reduce the carbon intensity of their power sectors this year, even as demand has grown. And they've done it more effectively than the United States and Europe. What's striking is how clear the divergence has become. Over the first 10 months of the year, China's carbon intensity averaged about 562 grams of carbon dioxide per kilowatt hour. That is a meaningful drop from where it stood just 6 years ago. India has trimmed intensity by roughly 5% this year, Japan by around 3%, and Vietnam by about 2%. Meanwhile, Europe has also logged improvements, but the United States stands alone as the only major power market where carbon intensity actually rose. And it wasn't subtle. A roughly 13% jump in coal-fired power generation has pushed emissions to a 3-year high. Why does that matter for commodities? Because shifts in power generation mix play directly into fuel demand patterns, price expectations, emissions-related policy, and ultimately corporate cost structures. Natural gas prices in the US have surged this year, pushing utilities to lean more heavily on coal. And with gas demand from LNG exporters soaring, higher gas prices and therefore elevated coal usage are likely to persist well into next year. That sets the stage for an American power market moving one way while the rest of the world moves in another. But let's move now to oil, where the most dramatic story of the day unfolded. The United States has seized a sanctioned oil tanker off the coast of Venezuela. President Donald Trump confirmed the operation, emphasizing the size of the vessel, described as one of the largest ever seized, and hinting that the US intends to hold on to the crude. The Venezuelan government called the action blatant theft and international piracy, and said it plans to file a formal complaint before global institutions. The vessel in question is believed to be the Skipper, formerly known as the Odessa, which has been sanctioned due to involvement in Iranian oil trading. Before the seizure, the tanker had loaded nearly 2 million barrels of Merry heavy crude from Venezuela and even transferred a portion of it to another vessel bound for Cuba. What makes this situation so significant is not only the direct interruption of Venezuelan export flows, which were running above 900,000 barrels per day last month, but the broader geopolitical signal. Until now, Washington had pressured Caracas but avoided interfering directly with oil movements. That norm is now broken. Markets reacted quickly. Brent crude climbed to roughly $62 per barrel, with US West Texas Intermediate closing in the upper $58 range. Analysts say this won't fundamentally alter global supply in the long run. Those barrels were already expected to sit unsold for some time. But it vividly demonstrates how sanctions-driven geopolitics can tighten spot availability and amplify risk premiums. And all of this lands at a moment when the US is pushing harder against Maduro's government and escalating maritime operations across the Caribbean and Pacific. In fact, Washington has conducted more than 20 strikes on suspected drug vessels since September, drawing growing criticism from legal experts and public skepticism at home. Shifting over to the Gulf of Mexico, we saw a major lease sale, the first since 2023, with BP, Woodside Energy and Chevron emerge as the biggest. Nearly $280 million in high bids were submitted. While that is lower than the last auction during the Biden administration, companies actually bid more per acre than at any time since 2017. This tells us two things. First, predictable leasing schedules matter to industry players. And second, despite all the talk about energy transition, deepwater Gulf assets remain premium long-term plays. BP secured 50 tracks, Chevron took 22, and Murphy Exploration captured 14. The largest single bid, close to $18.5 million, came from Chevron for a deepwater block in the Keithley Canyon. The Interior Department also offered acreage at a royalty rate of 12.5%, the lowest allowed under recent tax legislation, aimed at boosting participation. And it appears to have worked. The Gulf remains a cornerstone of US offshore production, and today's auction underscored that companies are not stepping back. Let's move now to metals, where rare earth supply chains continue to sit at the center of geopolitical tug-of-war. China has begun issuing a new wave of what it calls general export licenses for rare earth magnets, and Ford Motor has confirmed that its Chinese suppliers were included in the first batch. These year-long licenses, agreed upon following a meeting between Presidents Xi Jinping and Donald Trump, are designed to ease bottlenecks after Beijing's April export control measures brought parts of the global auto industry to a standstill. But while some US customers appear to be getting relief, Europe is being left behind. Germany's foreign minister openly stated that its automakers were excluded from this first round of approvals, despite decades of industrial ties with China. Companies like BMW and Volkswagen are carefully monitoring the situation, but have not received assurances. And this is why rare earths remain one of the most strategically fraught segments of the metals landscape. Licensing decisions can shift entire manufacturing supply chains overnight. Another Chinese producer, Ningbo Jintian Copper, announced that it too received streamlined licenses, reinforcing that Beijing is willing to selectively open these flows, but only on its terms. For sectors like electric vehicles, wind turbines, robotics, and aerospace, this continues to be a high-stakes guessing game. Now, let's turn to agriculture, where US farmers are confronting another year of deep financial stress. President Trump's $12 billion aid package has been welcomed, but farmers and lenders alike say the money barely scratches the surface. Losses for major crops this year are estimated between $35 and $44 billion. Low crop prices, elevated input costs, and weakened export demand, especially for soybeans, have all contributed. Soybean farmers were hit particularly hard when China halted imports between May and November. Analysts estimate the aid will cover only about 1/4 of the damage. For specialty crops like potatoes, the numbers are even starker. The sector faces roughly $500 million in losses, while receiving access to only a sliver of the available support. Farmers are calling this package a bridge, just enough to slow the bleeding, not enough to restore stability. And lenders caution that fewer than half of farm borrowers may be profitable next year. With many producers relying on government payments primarily to reduce debt, rather than reinvest in operations, the sector is navigating a fragile moment. Finally, on the dry freight side, Asia's feed markets were active. Taiwan purchased about 65,000 tons of US corn, while South Korea acquired a similar volume of feed wheat. These are routine flows, but they underscore ongoing confidence in US supply, even amid agricultural strain at home. It's been an intense day across the commodities spectrum. Geopolitics rewriting oil flows, Asia outpacing the West on clean power progress, the Gulf of Mexico drawing fresh investment, rare earths reshaping automaker strategy, and farmers grappling with daunting economics. As always, we'll keep unpacking these stories as they evolve. If you found this episode valuable, be sure to subscribe, share, and leave a review.